Hello everyone and welcome to today's webinar on 12 fundamental differences between personal and business credit. I'd like to thank everybody very much for taking the time to attend this webinar. Like always, my goal today is for you to leave here with at least one, hopefully many more than just one, bits of information about business credit and understand better and more in depth how business credit works. So what we're going to do today is take a direct comparison of business credit versus consumer credit. We're going to break it down. We're going to look at all the main differences between business and personal credit. What makes the two so different in scoring, in structure, in how much people get approved for, in all of those factors we're going to take a look at today. And I think it's a great topic for a webinar because when I owned a credit repair business, I was asked these questions all the time. I mean, I constantly had customers come up, want to know about business credit, want to know about fundamental differences between business and personal credit. So today's a great opportunity because you're actually going to break those down. We're going to leave the webinar today with you having a very good understanding of how business credit scoring works versus consumer scoring, the reporting agencies, and a lot of other details. So let's go ahead and jump in. We've got a lot to go over today. First, let's take a look at the actual reporting agencies. Now, there are three major credit reporting agencies in the consumer world. Okay, Equifax, Experian, and TransUnion. Equifax and TransUnion are the most widely used of the three, with Experian coming in a distant third. Experian's not used by a lot of sources. You know, if you're talking about, especially, for example, in a car loan, car loans, usually they're using TransUnion or Equifax. A lot of major lending decisions nowadays are made by two of the three, unless it's something like a mortgage that, of course, takes a look at all three of the bureaus and scores. Now, there are a few other consumer reporting agencies, but they're not big players. Some of these include, and some of these are credit reporting agencies. Some of these are just reporting agencies where data is actually reported on consumers. Innovis, Check Systems, National Consumer Telecom and Utilities Exchange, LexisNexis, ChoicePoint, MIB, Insurance Repository, First Advantage, SafeRent, Telecheck, and many more. Now, in the business world, there are three major reporting agencies also: Dun & Bradstreet, Experian, and Equifax. Okay, now D&B is by far the largest credit reporting agency in the business world, but has no place in the consumer reporting world. Okay, so that's one of the big differences between the two, is in the business world, Dun & Bradstreet, leaps and bounds, is the biggest player when it comes to business credit. But in the consumer world, they're not even a player. They're not even a player at all. Now, and even though TransUnion has a major part with consumer reporting, of course, they are one of the major consumer reporting agencies, they also really play no role with the business credit reporting. Okay, so a big fundamental difference is the reporting agencies themselves. Dun & Bradstreet's a big player in the business world, and although TransUnion is a big player in the consumer world, they're just really not big players when it comes to business credit reporting. Now, there are a few other business credit reporting agencies also, but they're not big players. Business owners don't need to worry a lot about these. PayNet, FD Insight, Business Credit USA, and Client Checker are a few of these other little-known reporting agencies, but I always like to mention them just so you can actually see that they are there, because once in a while you might actually come across them, and it's good to know that these are just other smaller business credit reporting agencies. Now, all three consumer reporting agencies have similar amounts of records on file. They're pretty similar in size. Okay, in the business world, Dun & Bradstreet is massive. I mean, they're just way bigger. They have over 10 times more records than the next closest credit reporting agency, which is Experian. In the business world, Dun & Bradstreet has about 206 million records, while the next closest reporting agency, Experian, only has 27 million records. 27 million versus 206 million. So it's just really lopsided. In the consumer world, the three are kind of equivalent with the amount of data, those type of things they collect, where in the business world, it's completely lopsided, whereas Dun & Bradstreet has more data on file, has double the data on file than every other credit reporting agency combined. Okay, D&B again holds over 200 million records on file, while Experian only has 27 million. Okay, the three consumer reporting agencies can provide credit report details with consumers within the United States. The three business credit reporting agencies provide business evaluations for companies worldwide. Now, some of the consumer reporting agencies are offering consumer credit in other countries, okay, but USA is their major their stomping ground. In the business credit reporting world, that's really not the case. Actually, most records for the business credit reporting agencies are not in the United States. Actually, with D&B alone, less than 17% of their total records were even on this continent. We're even in North America. Okay, so less than 17% of their total records are even in North America, whereas in the consumer world, almost all of their major records are held within the United States. Okay, one of the biggest differences between personal and business credit is really how credit scores are actually calculated. Consumer credit scores predict a consumer's risk of defaulting, while business credit scores predict a business's risk of defaulting. Not the business owners, but the business itself, its risk of defaulting. Okay, now consumer credit scores predict the consumer's risk of going over 90 days late on an account within the next 24 months. While business credit reporting also predicts the risk of going 90 days late, but within the next 12 months. This is big. I mean, this is one of the biggest, most fundamental differences between business and personal credit scoring. Right there, that simple number, 12 versus 24. Consumer credit is gauging the risk of somebody defaulting over the next 2 years. Business credit is gauging the risk of somebody defaulting over the next year. Big fundamental difference between the two when it comes to credit scoring. Now, personal credit scores are based on 5 factors. Payment history accounts for 35% of the score. Utilization or usage of available credit accounts for 30% of the score. Length of credit history is 15%. Accumulation of new credits 10%. And credit mix is another 10%. So combined, these equate to 100% of the total score. And that is how actual consumer scores are calculated. Now, in the business world, business credit scores are based only on whether the business pays its bills on time. Now, what I'm really showing you here is actually D&B's Paydex score. Again, since they are the major player, I figured I would give you a comparison between their score and consumer scores. The other bureaus do have a little bit difference in scores, but fundamentally are very similar. So in business credit scoring, as you can see, the score is based only on how the business pays, period. You know, if the business pays its bills on time or promptly, it has an 80 score. If it pays it really early, it has 100. If it pays it really late, it's got a 20. And literally that score depicts how many days on time, before or early or late they are actually running. That's it. It's really based on that one main factor with D&B versus the consumer scores, which are actually based on those five factors. Now, personal FICO scores range from 350 to 850. Vantage consumer scores range from 501 to 990. If you're not familiar with Vantage scores, Vantage is the credit bureau's attempt to get into the scoring game. It's as simple as that. The credit bureaus have decided they no longer want FICO to make all the money when it comes to scoring, so they've decided they want to make money with scoring. So many years ago, they invented Vantage Score, which is their basically credit score, the credit bureau's credit score. Vantage really isn't widely known. Less than 5% of financial institutions even use it. The most common place people see it is on True Credit. If they get credit monitoring through True Credit, because it's owned by TransUnion. It's TransUnion trying to peddle their own score through their own credit monitoring site. Outside of that, you're just not going to see Vantage Score a lot, but I thought I would at least give you the difference between both the consumer scores, Vantage and FICO, versus the business scores, which usually range only from 0 to 100. Pretty simple. You'll see a lot of things in the business scoring and credit world are pretty simple. It's easy, much simpler and easier than it ever is on the consumer side. Okay, so big difference in credit scoring. Business scores usually range from 0 to 100, while FICO scores range from 350 to 850. Now, a business can obtain a business credit score in less than half the time it takes to establish an actual consumer credit score. Wow, that's a big difference. You literally can build a business credit profile double as quick, twice as quickly as you can a personal score. Because a personal consumer score takes 6 months of reporting for a score to be established. Meaning if somebody comes out, has no credit profile, they go get accounts, they add accounts to their credit report, it will take 6 months for a score to be issued based on that data that's reporting. In the business world, it only takes 3 months or less of reporting for a credit score to be established. Dun & Bradstreet quotes that it could take up to 3 reporting cycles I'm with my fingers, I'm doing quotations. Nobody can see that but me. I'm doing quotations. So 3 reporting cycles is what they say. So that means 90 days. It could take up to 90 days for that score to be established. I have seen it happen in as little as 30 days. So it's very practical for somebody to get accounts that report to the business credit reporting agencies and have an initial score established within 30 to 90 days, whereas consumer reporting, no question, hands down, you have to have 6 months of reporting for a score to even be given. So literally, you can establish initial business credit scores in half of the time of what you'd see with consumer credit scores. Now, consumer reports offer only 1 score per bureau. Okay, you pull even if you pull a tri-merge credit report for a mortgage, you get 1 score with TransUnion, 1 score with Equifax, 1 score with Experian. But business reports typically show multiple scores for each business on the same report. Business reports show the primary score, such as the Paydex or IntelliScore, the primary business credit score. They also show other scores, okay, such as Dun & Bradstreet's supplier evaluation rating, or their supplier stability indicator, or Equifax's small business credit risk score for suppliers, or Equifax's business failure score. Okay, just like in the consumer world, there's a lot of different credit scores out there. But in the business world, you will commonly pull a report and get 3 or 4 scores on that one report. You'll have the overall score. They might have a supplier evaluation risk score. They might have a score on there that depicts the business's risk of filing bankruptcy. So it's very common to see a business report with 3 or 4 scores. Actually, it's not uncommon through a place like Experian to even get a merged report which shows both the consumer data and the business data and scores on it. Okay, so big difference. Consumer scores, you're only going to see 1 score per report you pull. In the business world, it's very common to see multiple scores that indicate different elements of risk on the same report to help those vendors issuing credit make better decisions. Okay. The consumer credit reporting agencies don't really have a hand in helping consumers build personal credit profiles. You've never heard that, right? I mean, you don't go out and Equifax and TransUnion aren't advertising, contact us today to start your credit profile, okay? They don't really have a hand in actually building the credit. They mainly just report and gather data, and they don't really help consumers build their personal credit. But in the business world, the business credit reporting agencies promote business credit, even are the major players with the actual building of business credit. Okay, it's all about data. You know, and in the consumer world, the consumer reporting agencies kind of have it made because everybody knows about consumer credit. You know, most people report to the consumer credit reporting agencies, so they just do not have a hard time getting data. And remember, that's what this is all about. Okay, people forget what the credit reporting agency's sole purpose is. It's to collect and sell data. That's what they do. They sell data. Okay, so the reporting agencies on the consumer side can easily obtain this data because so many people report to them. On the business side, it's a different world. 90% of the people don't even know what business credit is. So it's harder for them to collect data, and that's why they have such a major place in helping people build business credit. They're big on the education side to help educate people on why you'd want to build business credit, because they need people to build business credit to get more data, which again is the heart of any credit reporting agency. Liability. With consumer credit, the individual consumer is liable for the debt. When you go out and you get credit, okay, and you sign on the dotted line, you're responsible. So with business credit, though, the business is liable for the debt, not the business owner. Okay, so in the case of default with consumer credit, the borrower themselves, the individual consumer, and their personal assets can be pursued in case of default. Pretty simple. Okay, you have a credit card, you get a credit card with Chase, you default on the credit card, Chase comes after you, they file a lawsuit, they get a judgment, they attach the judgment as a lien on your home. Okay, that could happen all day long in the consumer world because you are personally liable. But with a business, in the case of default, the individual borrower and their personal assets cannot be pursued. Okay, in that example, Chase could not file a judgment on the person. They could not attach that judgment to the person's personal home. They could only come after the business and business assets. So they could go after the business, they could try to get a judgment, or they could try to take legal action against the business itself, but they could not go after the business owner. So that means with business credit, all of the business owner's personal assets are safe. Okay, their cars, their homes, their stocks, bonds, money in the bank. None of that stuff can be touched if they ever default on any business obligation. Right here is one of the biggest reasons people build business credit. This is it. This is it. People want no liability. Wouldn't it be great to get money with no liability? Well, that's exactly what business credit does for you, and that's exactly why most business owners really should have business credit. I was just actually looking at SBA's website today that was actually promoting the exact same thing about how bad of an idea it is for business owners to use their personal credit because they're personally liable for the debt in case of default. And another big difference is with consumer credit reporting agencies strongly dislike credit repair companies due to the money it costs them to handle disputing. Now, the business credit reporting agencies love business credit companies as they help business owners build credit, giving the credit reporting agencies more data, which is what they really want. Okay, look, there really is, in the consumer world, obviously, there aren't really companies that help people build consumer credit. The main companies in the consumer world help people actually get derogatory items off the credit report. Okay, they're credit repair companies or credit improvement companies like I used to own. Okay, and in that case, the bureaus do not like credit repair companies. As a matter of fact, so much of the bad stigma the industry has is because the credit bureaus have such a problem with the industry just because disputing costs them so much money. But in the business credit world, there really is no business credit repair. There is just business credit building. And again, the business credit reporting agencies love anybody that's in the business credit industry because they're helping people build business credit, inevitably giving them more data, which again is inevitably what all the business credit reporting agencies truly want to have. Regulation. The Consumer Credit Reporting Agency deals with many forms of regulation. Okay, the Credit Repair Organization Act governs credit improvement companies. The Fair Credit Reporting Act regulates credit reporting and what bureaus can and can't do. The Fair and Accurate Transaction Act also helps regulate credit reporting. But there's no such additional regulation in the business world at all. Okay, there's no regulation that applies to business credit companies, and there's no regulation dealing with how business is collected, data is collected and reported. There's also no regulation that assists with disputing inaccurate information on a business report. So as a result, there's no such official thing as business credit repair. Big thing you should know. When I was in credit repair, people asked all the time. They didn't know what business credit was. And a lot of people believed that it was business credit repair, just like there is consumer credit repair. But in the reality, there really is no official business credit repair. Now, don't get me wrong. I'm not saying things can't be fixed. They absolutely can. It's a process of working with the creditor, working with the reporting agency to get the item fixed. Sometimes it can be done in a few days. Sometimes it takes a few months to get done. But there's no official process. There's no regulation. There's no law that says they must do this. If you send a letter, the bureaus must act this way. There is no such regulation. So as a result of that, there really is no business credit repair because, again, consumer credit repair basically exists because the Fair Credit Reporting Act regulates, and laws like FACTA regulate what the credit reporting agencies can and can't do. Okay, it gives people the authority, that legal permission to basically go in and dispute the negative items. And then it, by law, forces the bureaus to have to respond to those disputes. Well, there is no such regulation in the consumer world at all. Okay, so that means there really is no business credit repair. It also means that clients operating in this space, customers offering business credit, have a much easier road than credit repair companies do because there's no additional regulation. The bureaus don't dislike the industry, so it's just a lot easier as a result for business credit companies to operate than credit repair companies because they don't deal with all this kind of additional regulation, such as the Credit Repair Organizations Act. And again, they don't have, that problem with the reporting agencies like you see in the consumer world. Okay, now another big difference is most consumer credit reporting starts with co-signed accounts or secured revolving accounts. Okay, most people who start building a consumer credit report start with these accounts. Okay, me, I'm a co-sign. Okay, my dad co-signed for my first car. When I went in, graduated high school, went in the military, my dad co-signed. He got me a car, and by the time I was out of tech school, I had Premier, or before I was done with my official tech training that took about a year and a half, I already had good credit, because that first year and a half where I was in my initial training in the military, I had a vehicle loan that I was paying as agreed and building credit. This is how a lot of people start. They have a family member, a friend co-sign for them for their initial credit, or if they don't have that, they start with a real low balance secured card, $200-$300 type secured card. I mean, most creditors are not just going to give someone with no credit score profile initial credit. It's a problem in the consumer world. Somebody that has no score, no credit, you're probably not going to get approved for $300, $400, $500 even limit cards in a lot of cases until you establish that initial credit, which is usually done with those co-signed or secured accounts. The main exception is when the consumer is assisted by a good credit co-signer, and another exception, as we just talked about, is when they're assisted by secured credit cards. Okay, now the business credit mostly starts with business owners getting approved for vendor accounts that report to the business credit reporting agencies. Okay, most of these are actually not secured cards. Okay, so unlike consumer credit that starts with secured cards, co-signed accounts, that's not really how business credit starts. Business credit doesn't really start with co-signed accounts, nor does it start with any kind of actual secured accounts. It starts with what are known as vendor accounts, which later on this webinar we'll take a look at some actual vendor accounts. And most of these vendor accounts are not revolving accounts like consumer credit. Instead, they offer terms like net 30. Okay, so a couple big differences here I guess I'm talking about in the same slides. First of all, in business credit building, you start with vendor accounts. You don't use secured accounts. You don't use co-signed accounts. People will give you credit. Even with no credit profile and no score, they will give you the credit to help you start reporting without a co-signer, without security, without the secured cards. But the trade-off is they're net 30 accounts to start, which means they're not revolving. You can't, just pay a little bit each month on the balance. You have to pay off the balance in full at the end of a 30-day cycle. So if you get approved with a Staples business vendor account, then you could use that Staples account, but you have to pay your balance in full at the end of the month. It's not a revolving account. So big fundamental differences between how the beginning of business credit building initially starts versus consumer credit building. Now, another way a business can build their credit is work with credit reporting agencies to have existing vendors that the business deals with reported on their credit. Once these creditors were added, the initial credit report and score can then be established. And in the consumer world, supplemented accounts added to reports would have no impact on scoring and not really help the initial credit profile. So with business credit building, there's two ways to do it. You could start from scratch, get vendors and add them to your report, or you can go to companies you already have relationships with, a company like RingCentral, who you have your phones with, and you could work with D&B and have that RingCentral account added to your credit, build a profile and score, and build your credit that way. Well, in the consumer world, if you were to have anything added or supplemented to the report, it wouldn't have an impact on the profile or score where it would in the business world. Okay, so just another fundamental difference of when it actually comes to the actual building of business credit. Another big difference is the actual building time frame. It takes years to establish an excellent consumer credit score. Okay, and part of the reason for that is something that we've really already talked about. It's because with credit scoring, it's just, it takes a lot longer to establish a good personal credit or business personal credit score than it does business. Okay, and that's due to many reasons, including that credit score calculations deal with factors like credit mix and age of credit history, which take time to establish. Look, the third biggest factor in consumer credit scoring is how long you've been in the bureau for. Well, how the heck do you control that? You don't. You can't control that. The only thing you could do is get added to authorized user accounts that people have had open for many, many years. So because you really can't control factors like age of credit history, it just takes time to be able to build consumer scores. Okay, that combined with the complexities such as mortgage and auto loans take years to typically qualify for means that these scores take longer to actually get approved. So what I'm saying here is that, okay, age of credit history, you can't control that, right? So it's just going to take you years to get that good anyways on your consumer score. Credit mix. Well, to have the best credit mix, you need one auto loan to two, You need 1 to 2 mortgage loans to get the best credit mix per FICO. Okay, well, the problem is it takes most people years of credit building to qualify for mortgages or auto loans. So because of it, it takes them years. It's a slow, steady process to ever build the consumer credit profiles and scores, just because of factors like credit mix and age of credit history taking so long for a consumer to establish. Now, another reason consumer credit takes longer to build is partially because it takes years to achieve higher credit limits. Okay, credit cards typically start as low limits, $300, $400, $500. When you usually start getting your first credit cards as a consumer, they're low limits. And then from there, it takes years to slowly raise the limits, and it's rare to see consumers with high limits such as 50 grand and higher. Okay, look, most people on the call don't have or have never had $50,000 type limits in the consumer world. But in the business credit world, that's not uncommon at all. The bottom line is you might start with a $500 limit consumer credit card. And, you know, it might take you 3-4 years for them to bump you from a $500 limit to a $1,000 limit or $2,000 limit. These companies don't just considerably raise your limits on your cards in short periods of time. It usually takes years and years and years and years of paying as agreed, establishing your credit to really start getting into high limit consumer credit cards. Okay, but business credit can be built quickly. Okay, this can be done in large part due to the fact that business credit scores are primarily based only on whether the business pays its bills on time. No other factor. So factors such as credit mix, length of established credit have no effect on the credit profile or score, paving a path to fast credit building. Okay, everything that makes consumer credit scoring and building take so much time doesn't exist in the business world. You don't have all these factors that affect the score. You don't have to deal with the right credit mix and length of credit history. Those things have no effect on the score at all. So because of that, everything is removed that slows down consumer building, making it business credit building so much faster because there's just not much resistance. There's not many things that make it take months or years to build that can be done in a fraction of the time that consumer credit building can be done. Okay, business credit cards will also start with the smaller limits just like consumer, but from there the limits grow rapidly as the credit grows. Okay, business owners can see limits of $10,000 or higher within 12 months of starting a business credit profile. Limits can then rapidly grow from there, unlike consumer credit. You don't see that in the consumer world. You know, I've never seen a consumer ever start with no credit and within a year get to even a $5,000 limit credit card unless it was secured. That would take years and years to establish. In the business world, though, it's actually practical and common that people can get $5,000, $10,000 limit credit cards right away within 12 months of actually starting the business credit building process. Okay, so it can just be done a lot faster in the business credit building world. And store business credit can also be built much faster than consumer credit. Stores like Staples, Dell, even Apple, which is completely spelled wrong. I put an I in there. Let me remove that. Act like it never even happened. Dell or Apple will approve a business for tens of thousands of dollars within a very short period of time. While consumer may never see high limit cards in these stores, and it for sure won't happen sooner than many years from the starting of the actual building. Look, most people don't have $10,000 Dell credit cards on the consumer side. In the business world, that's normal. That's common. Dell, if you get set up with Dell the right way, Dell pretty much religiously gives $10,000 limit cards. Apple, $2,000, $3,000 limit cards very quickly. Staples, and on and on and on. The bottom line is these store credit cards will issue a business owner credit a lot more than they will on the consumer side. I mean, it will take you many years to start, and you may never get to the limits that you would see on business cards versus consumer cards. It just takes a lot shorter time in the business world to go out and get credit cards with higher limits than it does consumer credit cards. You could easily get a credit card with Apple on the consumer side, get a credit card with Apple on the business side, and you would see the massive difference between the two. It's so much faster to get approved for higher limit credit cards in the business world than it ever will be in the consumer world. Now, a business owner can obtain and use massive amounts of business credit and keep an exceptional score if they pay their bills on time. So even after acquiring and using a lot of credit, the business owner still has the ability to qualify for even more money and credit. Okay. Now, if the business owner used the personal credit to do the exact same thing, the acquired debt would lower the score, affecting their ability to get more credit. Remember, available credit accounts for over a third of almost a third of the consumer credit score. So any increased debt affects utilization ratios and can dramatically lower the credit score. Okay, there's a lot of problems in the consumer world. One of the problems is that if you go late on one payment with one source, you'll start seeing other credit card sources lower their limits. And when they lower limits, those limits get closer to your balances, scores will sink. I mean, sink. Okay, I can tell you from the credit repair world that this was one of the best ways that we helped consumers improve their credit scores. We helped them get approved with credit cards with high available limits. And you would add one of these accounts to the credit report and see a 60 to 100 point swing in score. I mean, that's how much somebody's consumer score could be affected just based on the amount of money they owe on their credit cards or the limit in relation to those balances. But in the business world, this has no effect at all. None. So, for example, we commonly come in the business world. We get people approved for 10 credit cards. 10 credit cards with $10,000 limits on them. Okay, we got the person $100,000 and they all report to the business credit reporting agencies. Now, the beauty of that is because they report to the business agencies, these sources are only pulling consumer credit. They look at the consumer credit, they don't see the other 9 sources, they approve the person for more business credit. The other beauty is as these people get approved for these credit and as they use them, if those credit cards were to report on the consumer reports, well, then they'd be in trouble because they'd start using the credit. Okay, their scores would lower because the balances they owe on their credit cards are higher. Okay, so again, 30% of the scores based on available credit. As they're using up their available credit, their scores go down. Well, when those available credits on their business report, their scores aren't affected. So they can acquire all the credit they want to acquire and not lower their scores, where in the business world, this would have a dramatic effect on their scores if they started putting balances on their existing credit cards. Okay, this is really nice because a business owner that has consumer credit bill and business credit bill can use both as leverage and get easily approved for 2 to 3 times more money in credit because some accounts report to the business agencies, some report to the consumer agencies. The trick is to know which ones do what, and when you know that, then you can see that a business owner could dramatically get approved for a lot more money because, again, their business credit they're building doesn't report to the consumer reporting agencies, doesn't affect their utilization ratios. Approval amounts. Consumer credit limits tend to be lower compared with that of business cards. Even with the new credit profile, a business can and will be approved for significantly more credit than an individual consumer. With established credit, a business can qualify for limits well beyond what most consumers will ever see in the consumer world. Ladies and gentlemen, today on SBA's website, sba.gov, I was reading an article, and SBA says that the difference is 10 to 100 times more, quote unquote. Okay, so even per SBA, the approval limits on business credit accounts versus consumer accounts are commonly 10 to 100 times higher. Think about that. SBA is saying themselves that you can get limits on business accounts that are as much as 100 times higher than consumer limits. So if you ever wanted a good reason to build business credit, right there you go. Okay, not only is it much easier and faster to build business credit than consumer credit ever will be, but the limits given on these accounts are significantly higher in relation to consumer accounts. Just like SBA said, in some cases as much as 10 to 100 times higher limits than you'll ever see on the consumer side. It's just the way it is. $5, $10, $50, $1,000 plus limit cards are not rare in our world. We see them all the time in the business credit world, but in the consumer world, how often do you ever really see them? Some people on the call have maybe never seen limits that high. Okay, if you've got a lot of clients and you see a lot of credit reports, how often do you ever see limits even above 5,000? It's actually pretty uncommon unless you have very, very, very stellar client individuals that have had in the past a lot of other credit cards with high limits. If you don't have that rare scenario, then most people just don't have limits of higher than 5,000 in the consumer world. In the business world, most limits are there. Once you get your initial business credit bill, it's very common to see $5,000, $10,000 plus limits on those accounts. Like I said, a company like Dell, their standard is 10,000. That's kind of where they start in the business credit world. Whereas in the consumer credit world, you might get $500 or $1,000. So there's another simple example with Dell themselves of a company that easily approves customers for 10 to 20 times more in the business credit world than they ever would in the actual consumer